Good morning, everybody. Welcome to the Flow Show. Let me just get my camera going as well.
Good morning, Ryan. Good morning, everybody.
Morning, mate. Just got some bit of fun and games sorting out the tech because we've got the guys and girls joining us from ACAP again. 1 second. Let's get this going. Right. Hopefully this will work. Let's get that up and running. Can you see me right there?
Yeah, we can see you, mate.
And there as well. Right. Okay, so we're off and running at last. Yeah, as I said, welcome to the folks from ACAP who allow us to do their analysis this week, Mondays and Wednesdays. So hopefully they'll stay with us a bit longer as we run the Flow Show all week. So stay on board and we'll give you all the goods as we go along. Right, where do we start today then? Lots and lots and lots going on. Big market moves, big political moves, lots of stuff to get our teeth stuck into. We'll start by just having a quick brief over some of the data. If we go back to yesterday, just look at the US data. Factory orders was the only real number on the docket. Came up pretty strongly. It was May readings, so a little bit lagging, but they came in at 1.6% expected. Came in at 1.6% versus 0.5 expected. Ex-transportation, so taking out some of the bigger ticket items, came in at 1.7%. Durable goods were fairly decent as well. We got a little bit of revisions in there. And what we're looking at from these ones is whether we're going to start seeing some of this inventory build up that we heard from the likes of Target and Walmart, if that's going to drop out or if it's more widespread. Now we looked to see if maybe May had an effect in the durable goods. It didn't really, so maybe it's going to be June because that's when Target announced that they were going to stop building inventories, early June I think it was. So maybe we're not going to start to see that dropping out until next month's numbers. But on the whole, decent numbers there. Coming into today, not really too much on the docket around the globe. German factory orders came in a little bit on the upside, 0.1%. It was expected down 0.6%. So a little bit of a surprise there. Obviously, we've seen the PMIs and the more recent data coming in looking a little bit worse. So again, this may just be a bit of lagging data. Spanish industrial production as well, similar, looking pretty good year on year. Construction PMIs though that we got from several Eurozone countries, Germany in particular, in contraction still, some of the others falling into contraction. So again, this is a PMIs showing that the near-term data isn't looking too hot. The UK as well, construction PMI dropping from 56.4, missing expectations, down to 52.6. Eurozone retail sales, nothing special, up 0.2%, beat on year numbers, but again, probably some skew in there from the virus compared to the situation with lockdowns last year. Nothing major to take from all that data. Kat, I don't know if you get any expectations overnight, any news headlines you've seen before we get into the UK stuff?
No, not really. I think from the headline side, it's been relatively quiet. There's some ongoing stories in China about opening or not opening packages and things. So I reckon that's keeping the China market on its toes. But I haven't really seen anything outstanding that really would drive markets to a particular side in the headlines overnight myself. No.
Yeah. So obviously there was just a couple of lines. The Norway strike, the oil strike, has been averted. They came to a deal late last night or early this morning. So that has taken a bit of pressure off the situation in oil markets, production and not being able to get barrels out the door or out the ground. So that potentially has eased there. I'm also just seeing a bit more talk picking up on the FinTwit and the Wires and wherever about these bid and Z talks that are coming up soon. I think they might be happening sometime this week. So there's talks there. Obviously, the US is trying to get around what's happening in Russia, try and get China on board, trying and ease their inflation worries by, easing supply chains and things like that. We've had this talk of tariffs, which amounted to some 10 billion, a very low amount of tariffs that Biden would let go. These talks could potentially be big for markets and big for risk if there's bigger signs that tensions might be, thawing a bit more between the two countries, if they're open to communicating again on trade deals and, getting particularly supply chains moving a bit faster. So, as I say, this talk is just ramping up. There's no real huge expectations about what may come from this. So it could just be a case of we get the headlines, it's something big, it's something not. But that's due to come up and one to keep an eye on. But now we're obviously going to switch to the big news today, and that's what's happening in UK politics. Now, for those of you who are not from the UK or haven't seen the news, last night we had two big MPs resigning in Boris's cabinet, Syed Javid and, more importantly, the UK Chancellor, Rishi Sunak, both resigned. This is coming on the back of the latest scandal to hit Boris Johnson. He basically employed what's called a whip to the party. This guy had some prior problems, issues dealing with sexual misconduct, if you like. And there's been a bit of a hoo-ha about how much the Prime Minister knew about that before he appointed it. His first line was that he didn't know anything about it. His second line was that he might have known something about it, but he can't remember. And now it's all come out that he was actually told about 3, 4, 5 times that there was an issue with this guy, and he still went ahead and appointed him. Now, what happened yesterday was that a lot of ministers came out and backed Boris Johnson, backed what he put out there in the public to say that he didn't know about it. They were doing TV interviews, radio interviews, and now it's obviously come out that he actually knew 3, 4, 5 times, was told about this issue. And so all these people who put themselves in the firing line for him have now been shot down in flames. And we're up to about 14 resignations, I believe, at the moment, but with a lot of them being junior ministers, not cabinet ministers. And so it's the cabinet ministers resigning that are the important ones. And so far, Boris has replaced the 2 that have left, and the rest so far seem to be backing him. Now, what all that means for the pound, it's negative in terms of the uncertainty. Okay, but in the bigger picture, it's not too huge because this will likely develop into just a leadership contest, not a general election or anything like that. General elections are a bigger deal. A leadership change means a new guy or girl comes in, takes over, and as long as they don't make too many disruptions to policy, everything carries on as normal, the government carries on as normal, we remove that uncertainty. Only if we head towards something like a general election does it become more market moving, because it potentially means a change in government, a change in policies. That's big for investors, because they want to know that if they invest in a country, it's got a safe pair of hands in the government, a government that's pro-tax cutting, pro-business. But the big political upheaval in the UK is going to impact the pound more so than what we're seeing at the moment. Now, obviously, this is all coming amidst what we had some big moves yesterday in markets, particularly in the euro yet again. We had this big break of the 103.40 level. and it's pretty much kept going. It's steadied overnight, but really it's looking very dead cat. And just before coming on the show, we've had another fresh low knocked out. So really here it's showing us, you know, the market still wants to go lower. We've had this break here. It really hasn't looked back. It's not even had a sniff of going back to the 103.40 level. And watching it this morning, you know, we had some of these smaller levels developing, just the intraday levels, looking to see where the lows might be put. You know, 103.35.40 was where the market said this is enough for now, but the bounce is very weak. We couldn't even get up to you know, 102.80, which was the initial low after we made the breakdown. So looking at the close chart, this is what gives me the clues as to whether the market has had enough and going to bounce, or if it's going to continue. And we have to sometimes watch these small ranges, you know, 30, 40, 50 pip ranges, just to let the market decide what it wants to do. And here we are, 102.20s. The market's decided it wants to keep selling. So at the moment, we have no end in sight for this one. Now, I know a load of the guys in our chat room, the Forex Analytics platform, were short into this. I managed to sell some on the break as well. So I'm sitting in shorts, continue to sit in shorts in this one. It's just a case for me of just holding on and see it where it wants to go. On the technical front, you know, the next sort of levels aren't really down until, you know, we get down to some old historical levels. You know, we're going back again further than 2017, all the way back. It's going to be the low 102s, and probably around about the 101, 70, 80 mark. So what I tend to do is go back and look at the prior price action to see, you know, where was the traffic zones previously. But the break under this 103.40 is potentially decisive. It could mean that we finally hit that parity mark that a lot of people are talking about. That's obviously going to be a big psychological level in itself. But if we matched it off against the pound, it's done pretty much the same sort of thing. You know, we've had a break of the 120 level and it's just kept going. Now, a lot of people might be tying the pound to what's happened with the political side. And I have no doubt that that's part of it as well. But it's moving in tandem with euro dollar. It's moving in tandem with the other currencies versus the dollar. So how you work out how much is political in the pound trade and how much is just following the rest of the market, it's important why we look at crosses. So the main cross for this one, for cable, is euro sterling. Mainly because it's probably the biggest cross for two currencies, both the euro and the pound, obviously being closely correlated nations, right on the doorstep, a big trading partner. It's a big currency to watch. And so for me to try and ascertain how much of the political stuff is factoring into the pound and how much is the rest of the geopolitical worries, I look at euro sterling because it's a cross. And if that's moving more, so for example, if cable and euro dollar are moving the same amounts, okay, euro sterling shouldn't really be doing anything at all. It should be sitting around about the same levels. To tell whether it's the pound leading or the euro leading or lagging, the cross will tell you that. Now, euro sterling is a bit softer, okay, so that's insinuating that, you know, the pound's a little bit stronger. But over everything that happened yesterday, when we were dumping off in cable, this really wasn't doing an awful lot. So it tells me that the politics side of things maybe isn't a bigger influence than what we're seeing for the rest of the market. If we saw, you know, euro sterling back above 86, up challenging 87 on all this political news, I would be saying, yeah, you know, the pound's getting sold purely on the politics. But it's not. We're sitting in these tight ranges. You know, between 85 and 86s with some odd extensions above and below. And that for me is the importance of watching crosses, and you can look at the crosses in many pairs, and I encourage you to look at crosses. You don't have to trade them, but look at them to see which way the wind's blowing. So if you're trading dollar yen strongly, if you're trading euro dollar strongly, look at euro yen. It gives you an idea if there's a big move, what's driving it. Sometimes we can see, and as we've seen now, you look at some of these moves and think, right, well, it's all dollar strength. We see an Aussie dollar sold, euro dollar sold, cable sold, Kiwi dollar sold, and you think, right, well, it must be dollar strength. But then you need to look at the yen pairs. And if it's the yen pairs that are really moving, if it's the yen crosses, euro yen, pound yen, then maybe it's not the dollar. Maybe there's another driver, and the actual dollar reaction is just a byproduct. Because if you look at the dollar yen itself, well, everything's going on. Again, not doing an awful lot compared to what the others are doing. So then you get the feeling, well, if the dollar's really strong, you would expect dollar yen to be really strong. It's not. So while the dollar's strong versus the euro, it's not strong versus the yen. So where's the influence coming from for this dollar strength versus the euro, cable, etc.? And that's why you need to look around the crosses. You get an idea what exactly is driving it. And here we go. Look at euro yen. There we see the same sort of moves as we're seeing in euro dollar. So although this phase is and has been a big euro story, and I think that's probably one of the big leaders here, that it's a euro story. Looking at the crosses gives you an idea as to which way the wind's blowing and what winds are blowing which way. Kay, I know you look at the crosses an awful lot, and you trade them far more than I do in some of them. But you see the same importance in these?
Yeah, absolutely. As we've been saying from the start of the move, and yesterday over the shows as well, we look at one that we both are involved in as well. The Euro Canada has broken down as well, which would be not that logic if it's all like kind of a risk-off move, because in that case usually Canada would be a little bit more under pressure through dollar Canada or the crosses. But even Euro Canada and stuff like that broken. So it's been really a euro story, right? Since the start of Q3 really kicked off, we've seen this massive flow in the euro, and it dragged all the rest with it on the dollar pairs. But as you rightly pointed out, you look at any euro cross, it's lower. And all of that has to do, of course, with the dire European situation for energy and even like as I was saying yesterday, the German trade balance turning negative, the data coming out a bit weaker. It's all weighing on the euro, but it's a global euro story right now, coupled with other events in each currency, but mainly a euro story in my opinion. Yeah.
Yeah, exactly. And EuroCAD is a perfect example of looking at your correlation. So obviously with energy in the mix, we had a big move in oil. It came right off, but that actually caused EuroCAD to bounce. When it was just the euro story and before oil started to go, that's when we got the move to 133 in EuroCAD, and the bounce came when oil started to bounce. When oil really started somewhat, it got down just under 99, went to 98. That's when the CAD side of things, got a bit weaker, and the euro made itself a bit stronger on the back of it. As I say, probably more CAD weakness than euro strength, because there's no real reason to buy the euro right now. But it just shows that one moment this is following oil, the next minute it's not, and then it's back on again. But you can't use something like oil to trade, the correlation 100%. As I mentioned on other webinars, if you look too much at oil to trade CAD, just trade oil. Look at it to see, is that an influence? If you're trading currencies, if you're trading a CAD, look to see how strong the influence of the other correlations are in this terms oil. So even though we've got the bounce in EuroCAD, it's technically doing what it should do. We've got the little nose peep above the 132, 133.90, 134 area, but it didn't last. We're back below. We're holding below, holding below, holding below. That keeps the pressure on. That keeps the downside in movement intact, the bearish movement intact. Now we set up a bit of a range, probably 133.90, 134, down to the 133 big figure, and that little move below down to 86, I think it was. And that gives us the range. Now, I know, again, the guys and girls in our trading room are in this short. A lot of guys making good pips on that. I'm still short a little bit. I was reticent to move my stop down. I had my stop at 134.20 because I was playing the break trade here at 133.80. And even though we've got to move down here, I didn't want to bring my stop down. Usually I would try and get my stop under the break area into profit or as close to zero as possible. But it just, the volatility going on, I just didn't want to do that. That's hopefully proved to be the right decision. We got a bounce back, a volatile bounce back, but it fortunately didn't trigger my stop. And here we are, I'm still managing to stay in the trade and see where it wants to go. But if I find that I see further support down into the low 133s, I've got just half the position left, so I'll probably take more profit. And then we see how the price action develops. Are we going to build a decent range down here, a decent bottom? And then it becomes, well, what happens now? Do we break up? Do we break down? What it does do, it gives you the opportunity then to say, right, well, if 133 is becoming solid, that's a place I can look for longs. Conversely, if it shows a support for a decent amount of time, then I might try a sell stop again underneath if it breaks, because that'll mean likely we get a continuation. And the same can happen at the top now, 133.90, 134. If that becomes resistance for a decent amount of time, gives you conviction to try shorts against it, but look for that break back above and look for confirmation that it's had enough being below, because then we could be back up towards 135. So you don't have to have a bias, just trade the levels, and you can flip your position around if the price action tells you so. Okay, I don't know if you want to grab the charts and go through some of the other pairs that you're looking at.
Yeah, sure, mate. I was just going to add, indeed, on the Euro Cats, just stay on there for a minute.
Yeah,
I'm completely in agreement. It's tough to bring the stops down right now. I'm exactly in the same position. We sold. Well, I was short already a little bit before, but sold that break and watched it and took some off in down into the 133. I did not add on the rebound because it was looking a bit funny in the oil market, so I didn't add again. But technically, this is an absolutely beauty of a trade. We went above, even did probably some really short-term stops above 134 the figure again, but then we failed and we came back down, which reassures me that it's really still a euro story. But it's tough to bring the stops down already, and unless we would say somewhere around 133.60, 70 right now. But that's a bit in the middle of that test zone. So I'm going to hold off to bring my stops down to until we find some resistance inside this 133.34. Could be around 60, 70. Then it may be the case of starting to bring it down, so to bring the risk on the rest of the position down to zero, and then see what's going on. But I agree, it's a bit too early. I'm a little reluctant to bring it down right now. My stop is at 134.15, and I'm leaving it there.
It's funny because we don't hesitate to bring our stops down and get our risk down as quick as possible. That's the whole exercise, particularly for me when I enter a trade, is not about the profit, it's getting my risk to zero. But we've been highlighting this for weeks, and it was Kay who first started talking about this chart, and it just shows you when the techs work, they work really well. You won't get a more textbook technical chart than you have this. Multiple holds of a level, becomes a big support level, and the more times it's tested, the more times it holds, the bigger the break is likely to be when it does go. Because all those people who keep buying it off those longs, off those support areas, are going to be building their stops below. And the bigger those stops grow. So you do tend to get a volatile move on these big levels. But it's all about time and context. Much shorter time frame. Looking at a 15-minute chart, you get similar patterns, but obviously the effect won't be as much. Okay, mate, do you want me to stop sharing, and I'll let you have charts?
Yeah, let me grab it.
That's one. And yeah.
Okay. Right, here we go. Can you see my screen?
Yeah.
Okay, starting with my classic picture of the differentials in the German and US yields, and that's already one indication for me that it's not yet time to start to reverse euro. If we only look at it from a correlation side, perhaps technical side, there could have been a case of some profit taking in euro dollar. But this German-US yield differential is telling me that the story may not be over yet. It's still coming off this morning, and as a matter of fact, euro is hanging around the lows of the past sessions. Another point that I'm looking at, and to come back on the story, on the sterling story, this one in turn has stabilized, and so the sterling dollar differentials, they have stabilized for now. So I'm a bit reluctant to sell sterling if it would be on the political story. So we have to hang on just a minute, please, Ryan, because there's
yeah, I think you have to share your screen on the other platform as well.
okay. How?
So let me stop.
Okay, I hope this is fine. Sorry, guys, we are.
There we go. Yeah, all good.
Okay. So this is the sterling dollar differentials. It's not working too well on the 2 year, so I'm using the 5 years, which is inflation included. We might say working a little bit better, but one can really see how sterling cable is stabilizing in this zone, and the yields are stabilizing as well. It's one of those indicators as I'm looking at. I'm not basing my trade on it, but it's really something, and I like correlations, and I like to especially look at yield differentials these days because of the huge central bank moves that we're having going on. By the way, tonight we have the FOMC minutes coming out. I usually pay not that much attention, but the Fed being so hawkish, today the market may take any excuse to get the markets moving again on the back of it. So it's going to be interesting, at least for the shorter term trading, I would say, tonight's FOMC minutes. Now, where risk comes into play are these, and that's the dollar mix. The dollar mix is trying to break above this trend line, which is coming in from November 2021 over March 2022, and we are here testing these levels. We are right on it. Dollar mix is trading 2069. This thing is 2070. If ever we break, we could go and have a look at 2087. I find it a little, how shall I say, a little surprising, but it may be positioning or position cutting, or people not liking those recession fears, and so the emerging markets have been under pressure starting yesterday, really. But being such a high yielder and looking how the equity markets are holding up, I'm kind of surprised it came back so easily up to this 2070 again. But it's one to keep a close eye on, because I moved through there. I'm saying 2088, but or 8788, but we could be back at 21 relatively fast as well. If in turn we fail and we start to move below 2064, 2065 again, probably having found the more interesting one to me personally, because I'm not a big fan of the euro, as everybody will know by now, is the euro mix. which I'm still short of to a lesser degree right here and now. But I'm carefully monitoring this 24-27 zone. I'd like to get shorter again, even up to 2140, because I really think that for the time being, there's two things going on. It's, for me at least, it's the euro side, which is under pressure, and the next side. Ryan, could you mute while you're typing?
Sorry, mate.
Could you mute while you're typing, because it makes quite a bit of noise in the.
Yeah, sorry, mate. Yeah,
no problem at all. So I'm looking to rebuild my short in the Euromex, and my real alert level is going to be around 2141. So I was saying there's two reasons for it: is the weakness of the euro and the MEX still being a very high yielder in today's markets. So I want to keep this this strategy going for now. Another one showing that the emerging market sphere has come under pressure is the dollar rand. First of all, we broke above the 1635. Then we had the previous high 1649.50, and I told people yesterday that watch out if it goes through 1649.50, and we had the acceleration. We're already more than 1% higher. So we have to reckon here with a possible. I'm not saying it's going to happen. Move up to 17. It is really possible. In turn, we need to get back below 1650, and ideally below this 35-40 zone to call this one over. I'm lurking. I'm not sure if I want to really buy rand right now, but if it would be the case, I might look at something against euro, or perhaps if risk is starting to do a little bit better, maybe even against the yen. And that brings me to the yen side of things. We have in the short term, some people are seeing a head and shoulders in here, but okay, it is possible. But there is indeed intermediate support which lies right around 135. Looking at the yields, dollar yields have seemed to be stabilizing just a tad right now. But watch out if this breaks 135, which could lead us straight away into what, in my opinion, is the bigger support zone, 134, 30.50. This is really where, in my opinion, for the medium term, dollar yen is going to decide what it wants to do. If one wants to have dollar yen, of course, there's other pairs which are a little more funky right here and now, which is the dollar yen for sure. Yes, Hugo, I can look at that. Now, for the let me quickly move over to this euro yen. We had those moves. We have this triple top here that we were talking about yesterday, because CityTex was short and they got just kept in for 2 or 3 pips. Then we started to break back below 142.80, and then yesterday we had like the big drop which broke through 140.5, 140.25 were support levels. I think the bigger one here is around 137.70. Down all the way down to 136.75. This zone to me is a make or break zone for the euro yen. I'm not excluding more weakness because the euro is looking fragile, but the market is not one-way ticket all the time, and I'm starting to keep an eye on those US equity markets. If this S&P is managing to hold those 37s for a while, some of the yen crosses, in my opinion, may stabilize and perhaps bounce a little bit. But today maybe a little early. I'm not buying this one because I don't like the euro. I'm still a euro bear. But then Hugo came up with a good one, which is the Canada yen. I need to refresh it, so bear with me just a second. If risk moves back up, if equities hold, if oil, which is trading below $100 right now on the futures, on the futures I see just on my screen here, just below $100. If that thing starts to stabilize and hold, the Canada yen could be an interesting one for a bounce. I really think, because I'm going to show this one, which is a possible bull flag. It could still be in the making, which means that we are going to end up at one stage around 110, or 110 or 112, if I'm not mistaken. But to keep it in the shorter term, I think we must be careful. This is the oil break lower, where the yen also has benefited from, because if we talk about energy, if we talk about correlations, don't forget that the yen, Japan is a big importer of anything energy and other stuff. So the yen will and should and has benefited from the move lower in energy and commodities. So we have to be careful. But if it starts to move back up above, I'd say 104.5, this may be a decent bottom here. But I'm a little cautious and reluctant to start to catch knives in yen pairs right here and now. I prefer to see bottoms confirmed before really moving back in, because it is still possible that we are doing a move down to 103 in the Canada yen. It is very possible. Even the 102.5. 102.5, I kind of liked it, because this is where I bought it at an earlier stage on a rally higher. So this 102.5 is again a zone, because we can see it here, and here we see the 103. So this 102.5, 103 for me is going to be a medium-term zone of interest for what me personally am concerned. If we go back above 104, a quarter or a half, this could mean that oil has stabilized and starts to move up again. Okay, quick look at the usuals. Yeah, gold is a bit of a funny one for me, at least right now. I've been reluctant to do anything in it, and to be perfectly honest with you, I still am. But we are on decent support here in the 1760s. I really need to see something change, or the dollar start to change a little bit. Strength in the dollar starting to change a little bit to go and catch a knife in this one. But it is an important level to keep an eye on. If we ever start to crack it, why not getting back to here, 1720 before looking back. Once the dust will settle on everything, my longer term impression is, or my longer term plan is still to get long precious metals at some stage, but when is a big question. So for the time being, hands still. On silver, I'm still long term, a very, very tiny, this is something that I've started to buy. For those who followed Forex Flow, I started to buy in the 16s. Had an absolute blast when the Reddit community took it up to 30, and I took profits on everything. Since it came down again, I bought a really tiny one again, but I've got like an enormous amount of room to add, and I have a bid in at 1880 right now. We came close 1890 yesterday, but it's just an add-on to a very long-term one, but it's nowhere near full position that I want to have. I just think it's in preparation of what is possibly going to come later on. It could be end of this year or even into next year. But I'm all right to in very, very small amounts adding to silver the lower it goes, because at one stage the rebuild or the packages for infrastructure will kick in, and silver I think will be a leader when the rebound will start. But it's a very long-term thing, and for the time being, this channel, we might see a little bit of support down here. Then we have a question on the restream about how far this euro will fall. Prasad, I know the question is for Ryan, but if you allow me, Ryan, I'll have a quick look at the medium-term euro-dollar as well.
Yeah, I was going to say, how long's a piece of string?
Yeah, exactly. In my opinion, there's a really decent level at around 99, the figure percent. This to me is going to be important for two reasons. First, parity. If it falls down there, of course, conditionally to the fact that it will fall down there, I think it, in my opinion, it will. But you know, everybody can be wrong. It's going to be important, this 99, for two reasons. First of all, you have the parity just above. And parity is going to be psychologically important for a lot of people. It is enormous, right? It's parity between the two major currency blocks in the world, which are the dollar bit on the one side and the euro on euro block on the other side. So parity will be an important one. It's going to be a psychological one. I would suspect that two things could happen around parity. Either you have a massive round of profit taking, or lots of support due to barriers, or people who think it's gone far enough, and who think like parity shouldn't be, it shouldn't go below parity because of the importance and the size of two blocks, or the economic situation start to change a little bit, more favorable for the euro. That is one thing. And secondly, now why this 99 is going to be important, it's because we are further away from parity. Imagine that we have a round of stop losses kicking off below parity. Traditionally, or usually, I would say, you're doing like 20, 30, could be 40, 50 points on a quick stop run, and then we see a rebound. If in turn euro dollar starts to close under 99, it's a little bit like how will I confirm? How will I? There's a currency pair, like for example the 120, the psychological 120 in dollar yen. You try, you go above, you come back below, I think it's somewhere 118 or something like that, the rejection. But then we started to look at this 121 and a quarter, I recall. Once you start to move away from the big level and a close below or above, in this case below 99, that will mean that parity is already in the rear view mirror, right? So in my opinion, this 99 is going to be very, very important. It's also around the next springboard that we saw on the way back up in 2002. So that for me is going to be one important one to look if we get down there. And with that, Ryan, I think I'm going to pass it back to you.
Yeah, cool. So it's pretty much like we were talking about, you know, EuroCAD and things like that. It's looking for the confirmation of the breaks. You know, you can get a break, but it can fake out. You need to have that confirmation. That's what you rely on. So even if you miss a move, like a move through parity, you can always wait to see if you get that retest. If the retest starts holding below, then you've got a reason to get on board and try and run a short or run a break trade. And like Kay says, you know, if it then starts knocking out the downside levels, then that higher level then becomes a bit more stronger. And if we then go back, let's say after a few weeks, it's likely to be a very strong number again. And that's how the levels build, and that's how they build over the longer term as well. Now, I won't keep you guys and girls too much longer, but if you do want to join us in the Forex Analytics Traders platform, you can do so here. I've got a special discount since the merger, when I merged my chat room into the Forex Analytics platform. So you can get a 20% discount on the lifetime of your subscription by coming via forexflow.live/platform. So if you want to have a look at that, please do. Just want to highlight a couple of things that we've got on the docket this afternoon, particularly in the US. MBA mortgage rate index. This is a weekly number that I look at. It's been a good bellwether for what's been happening in the housing market. Everyone's talking about the housing market now. It's having problems. Interest rates are having an impact. We saw this coming at the start of the year purely because this index and the subcomponents had just been heading lower, probably since about January. I think just as we came through the January period, a little up period as the market came back from the new year, and then it was downhill all the way since. It has staged a little bit of a bounce. Whether that's a dead cat bounce or not, we don't know, but this is one that I keep an eye on. I won't trade it. It's not that market moving, but it's a good indicator for what's happening in the main numbers. Got a couple of central bank speakers waffling on as well, but then we get the ISM services index later on today. Like the ISM, that's going to be very important. This is the big one for the PMIs. We get the S&P global ones, the market numbers, but particularly for the US, these are the big ones. And so watching what happens here is going to be very important. We saw employment moving into contraction. Employment here in services just hovering above contraction. Are we going to start to see jobs falling, which is actually what Powell might be expecting and what he's sort of trying to work towards, taking some steam out of the jobs market. So a big number coming from that one, the non-manufacturing. We also get the FOMC minutes. As I've mentioned earlier this week, not really great importance these days, now that as soon as the FOMC is done, we get the floodgates open and every central bank bod comes out giving their view 20, 30 times a day. So there shouldn't be anything new in those to what we've already heard from the central bank meetings. So let's have a quick look, see if you guys and girls have got any other questions. And apologies once again for the sound issues. I had my camera on, I had my mic on, I had my mic off, so it must have been my camera picking up the noise. There's one for you, Kay. Do you use algos? Question there from Steve.
I've just replied. No, I'm old school. I'm clicking my mouse. I've been used to trading for decades as a bank market maker. So no, I'm old school. I don't do any algos. I don't do any. I'm my own algo.
Yeah, exactly. But the algo's in our heads, Stephen. Jordan just asked. He's saying he's waiting for the US Open today to see which way the S&P breaks. This has been a bit confusing, if I'm honest with you. Watching the S&P, it's not really doing an awful lot. We have had some moves lower, but really in terms of what's been going on in FX markets, particularly and bond markets, the messing around we've got going on in yields there. Stocks, and particularly S&P, seem to be taking a back seat to it all. There's been some decent ranges moving around, decent price moves to grab, but really, for me, it's not really indicating that it's following any particular trend. Obviously, we've come off the big highs, the all-time highs. So, the trend, particularly this year, has been lower. That's plain to see. But looking on a more intraday basis in the last few weeks, it seems to have stabilized somewhat. So what it does over here, it's really going to need to break this prior low that we got down in the 3630s. That's where the market has taken this trend and said, for now, that's enough. So that gives us a good marker. I know a lot of us are waiting for a move up to 141. I think that the whole world and his mate are waiting for a move to 41 to potentially get in some shorts. But if that happens, I'll be questioning why are we up at 4100. If we're up there from here, particularly, does it mean that something has changed? But in the meanwhile, yeah, I think there's a bit of sideways action. We've got to see whether that low is going to be solid. If we get another test on that low there, then that's going to be a pretty strong signal for a double bottom, and then perhaps we might start to move back up to the 41 area and see where the bounce wants to go. But this is all going to be down to the data as well, and the fundamentals. You know, profitability at companies. A rate hike's going to bite. Are they going to impact the consumer to such a degree that retail sales drop off a cliff? So lots in the mix for that one. But as you say, on an intraday basis, yeah, you know, you just trade the wobbles, if you like. You know, if we open up weaker, then you pick your downside levels. You know, look at these prior lows here, 37.40s. If that's where we're going to find support, that's what you trade off of. On the top side, you know, we're looking at the 38.50s again. So decent enough range to play in if that's your bag. And looking at Aussie dollar for potential long, still looking for a long hand.
Right.
Again, this is a yes,
okay,
mate.
No, go ahead. I'll because we have a question from an extra question from Prasant on the 8-cap restream, looking at Euro Swiss. Do you want to look at it, or shall I quickly grab the screen when you're done?
Yeah, let's. I'll speak to Anne quickly and answer Anne, and then we can look at it. So Aussie dollar, you know, here we are again, breaking down. It's not looking pretty at all. I've been saying for a while, it's not a pair I want to get in buying. If I wanted to get buying, I was looking at this low 68, but I had really no conviction at all. But where are we? Technically, we're right down on this 50 fib. You know, real close enough now to call that a test. So if you're going to pick your level to try against, here's a big number. It's the 50 fib of the virus swing up. You don't need to be a hero. You know, you only need a stop maybe 10, 15, 20 pips below, because if it breaks, it's likely to go further. But Anne, you know, as we're fond of saying, you've got the fib in there. You've given us a reason what you want to look at. If you want to try longs, but know the sentiment the market is at the moment. The sentiment is bearish at the moment. So if you want to fight that bearishness, reflect that perhaps in your trading. Maybe you trade a smaller size. Maybe you keep your stops a bit tighter, because the chances of trying to pick bottoms all the way along here, you know, you're really on the wrong side of sentiment and the trend. But I always say, give yourself a reason to fight a trend, and one of those reasons is a big technical indicator like the fib there. Euro Swiss. I'll have the chart up, and if you've got any particular text you want to look at, Kay, you guide me and I'll whack them on. So if you want to take the question, and I'll do the drawing.
Yeah, but maybe I take it quick. Just 1 minute.
Yeah, go on in. Yeah, let me. I'll hand over the baton. 1 second.
I need to do on both. Yeah, I need to do it on both. 1 second. Where is it again? Share screen. This one. Let's see. It's not coming up on the 8-cap.
Right, give me a second.
Here we go.
You got it? Yeah.
Yeah. So present. Okay, just looking at the takes of this rebound that we had, the first one in March from parity up to 105 basically. If we take just the pure extensions to the downside, we are looking at 98.25 and 96.40ish. which is also an extension of the move down to the other side. On the longer term, there is not a lot really before the panic stations level, which is roughly around those 96.40 extensions. That is the technical bit of it. But replying to a question as how far will euro fall versus Swiss, it's really a question that only not Michael. Why do I say Michael? That SNB's Jordan can reply to, because they will tell us where it's enough. For the time being, they don't seem to be panicking yet. They did tell us over the last board meeting, and when they hiked the interest rates by 50 bps, that in their opinion Swiss was less overvalued, which was an absolute rare statement from them, because we have heard them only on the other side of this statement for a decade. So where can it fall to? That's up to SNB's Jordan to decide. But if you look at it from a technical point of view, I think 98.25 and then 96, 30, 40-ish are potential targets for the move. I must admit, I was short. I've played the ping pong short between 102.5 and 100.5 for a while. And I took most of it off when we had the rebound from 99 back above parity over month end. I took most of it off. For the time being, I'm not really looking to sell into the hole. But if ever we see moves back up to 101, and especially this one, which for me is a big zone, the 102.5, especially if we get back up there, I'm going to be very tempted to start to put on shorts again, unless the European fundamental situation changes completely in the meantime. But I think, Swiss will remain one of the better currencies right now. It's traditionally been a parking spot for a lot of wealth money, and I don't think that the situation or the global picture for the Swiss has really changed that much. And one last thing, when Anne was asking about the Aussie, and
just before you switch that, mate, I just want to ask you a question on something like Euro Swiss.
Yeah.
Obviously, I don't know if you want to zoom out to a weekly or something. Obviously, there's lots of questions over that 2015 cap pull by the S&P over what the actual low is. So using that as a gauge for drawing techs off becomes difficult. But that aside, we are at multi-year lows here. How do you run techs on empty air, if you like? When prices move where they haven't ever been before. What elements do you use to draw your text from, or do you just let the price action develop itself?
Okay, so you can for instance draw lines. That is one thing, because if you take for instance this one, but okay, we've never had a retest there, but this looks like people call it a megaphone or kind of channel we are in. Then you need to find the channel, but this is not going to work. You need to find like channel targets possibly, or what I just did is, if you take the move back up, all right, here, this one, what I just showed. If you take this move back up, and then you start to mirror this move down to the other side. Really.
Extensions, yeah.
Yeah, and you start to mirror these moves to the other side. People are adding some in between, above, but I like to keep things relatively simple. My charts are already enough spaghetti charts, so I'm trying to keep it simple. But it's more like projections.
Yeah.
Of these kind of moves to down to the other side. There's unfortunately not a lot else that in my opinion, at least in my simple mind, we can hang on to. But that is basically how I do it. Or then you start to look at what I did for the euro dollar in when it broke 117. I know you don't like it, but the head and shoulder, it did play out well because it showed the 111 first major bounce level back up to 115, and then it did show the 108 as well. There are technical indicators that we can use to find targets. The only thing that people will have noticed by now is that I'm not using RSI or RSI or anything else. I think the market can remain overbought, oversold for much longer than we can remain solvent. So I'm not really using them, but I know that people, and I respect it a lot, people watch it. Okay, just one last thing, and I did buy Aussie of the 50% retracement myself, so I'm a little bit long Aussie, and I'm using exactly what Ryan showed to put my stop below. But it's just a relatively short-term try, and that's me done for now.
Cool, thank you very much, Kay. Yeah, once again, sorry for all the technical problems we had earlier. We'll get those ironed out for next Monday when the 8-cap boys and girls join us again. We'll let you get back to your trading. Thank you very much for joining us on the Flow Show. Thank you to Kay, and stay safe with your trading. I wish you many pips, and we shall see you tomorrow. Thank you very much.